Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young, and welcome back to What We Learned in the Markets This Week. The stock market this week defied market cap weighting. Now, what does that mean? What does market cap weighting mean? Well, because the stock market indexes like the S&P 500, which tracks large U.S. companies, and the NASDAQ, which tracks more growth-oriented companies, and many other indexes are market cap weighted. It means that the largest companies hold the largest percent of weightings, and it's becoming larger and larger. It's not going the other way or staying stagnant. It's concentrating a lot more deeply. For example, the S&P 500, as of Friday, the top 5 companies control 26.9% of the index. In the NASDAQ 100, it's a lot more concentrated. Apple, Nvidia, and Microsoft, the top 3, control the top 25% of the weighting. Therefore, if those stocks have a bad week, it's highly likely the market is going to have a bad week. Well, 2 of those 3 stocks this week, Apple and Nvidia, fell 2% and 4% respectively, but the market still had a good week. Now, that's a great sign that there is breadth across the rest of the market. So let's dig into our normal roundup of economic data that we review each and every week to see where the economy is currently sitting to justify what's happening in the stock market or try to clarify what's happening in the stock market. First, we start out by reviewing the Atlanta Fed's GDP Now report. This report tells us in real time where the economy is sitting in terms of the growth of gross domestic product, a broad array of things in our economy. As discussed last week, the report did not update. So this week we got 2 of them twice, and the most recent number came in slightly slower than last week at 3% even on the dot after the housing starts data, which we'll talk about here in a bit, came out on Thursday. 3%, still a very strong number. It's about 1% greater than what Wall Street is currently expecting in terms of GDP growth for the end of the quarter, and they're thinking 2%. Next, let's look at mortgage rates for the 15 and 30-year version. Those we have coming in at 6.13% for the 15-year mortgage and 6.87% for the 30-year mortgage, continuing their trend downward for the last 3 weeks. And how about the initial claims for unemployment insurance for a peek into the front end of the unemployment market? That came in at 238,000 this week, so another week of low unemployment claims for initial filers. And finally, let's look at the markets and how they ended the week. First, the S&P 500, which is our proxy for growth in income, but only when considered together, that was positive 0.56% this week. Next, the Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive 0.82% this week. And finally, the MSCI EAFE, which tracks the stock markets of developed countries all around the world, excluding the U.S., that was positive 0.15% this week. So aggressive growth came in, took the cape, won the prize, top performer this week. Point number 2, how about a quick update on U.S. manufacturing production? This part of our economy saw a larger than anticipated increase in May of 2024, the results we just recently received this last week. And those rebounded from revised data showing declines in the previous 2 months, as you can see on your screens. The IPI was created by the Federal Reserve to measure the performance of industrial production, which, what does industrial production even include? Well, it includes manufacturing, mining, electric and gas industries. And if this index has a value over 100, it shows positive production performance, while a value that is below 100 indicates an industrial production performance below the standards of the base year. Now, the Federal Reserve reported that manufacturing output rose by 0.9% in May, nearly 1%, but 0.9%, surpassing economists' predictions of a 0.3% increase. This growth brought the Industrial Production Index, again IPI, to 103.3. However, despite this recent surge, Experts believe this momentum may be short-lived due to factors like high interest rates that ultimately slow down the economy and put pressure on growth and a decline in demand. Several factors contributed to the May increase in manufacturing output, and those factors were motor vehicle and parts output. Those were recovered by 0.6, following a 1.9% decline in April's numbers. Additionally, durable goods manufacturing production saw a 0.6% rise, driven by significant increases in the production of wood products, machinery, computer and electric products, and furniture. Non-durable manufacturing production also experienced a substantial 1.1% increase in this last May 2024 report. Despite this positive development in the manufacturing sector, retail sales was another number that was released this week, and those actually came in weaker than expected in May of 2024. While retail sales did rise by 0.1% for the month, this figure fell short of the 0.2% increase projected by most Wall Street economists. Excluding auto, sales actually declined by 0.1%. And this weakness in retail sales reflects ongoing challenges consumers face with affordability and high inflation over the past few years. Just not a ton of extra money right now to spend on retail sales. The dampened consumer spending responsible for about 2/3 of all economic activity. Again, us, the consumers, we're 2/3 of the economy. That could potentially signal a slowdown in economic growth and might influence the Federal Reserve's decisions regarding interest rates. In other words, that might spur them to start lowering interest rates. Point number 3, now an update on the housing markets. The U.S. housing market is experiencing a slowdown currently, and that's nothing new. We knew that, but that's primarily due to a combination of rising mortgage rates and escalating building costs. This has resulted in a decline of new home construction, and that can be evidenced by the falling number of what's called housing starts. Now, housing starts refer to the start of construction on a new residential housing unit. In May of 2024, housing starts for privately owned units fell 5.5% from the previous month to a seasonally adjusted annual rate of 1.277 million units. This figure represents a significant drop of 19.3% compared to the same time just 1 year ago. Now, single-family housing starts, which constitute the majority of the housing market, also experienced a 5.5% decline in May, reaching 982,000 units. This slowdown in construction activity is indicative of the challenges faced by the home building industry. Building permits, which are a key indicator of future construction activity, also reflected this downward trend. May of 2024 witnessed a 3.8% month-over-month decrease down to the downside and a 9.5% year-over-year decline in residential building permits. And though that brought them in at an annualized rate of 1.386 million units. Permits for single-family homes experienced a 2.9% decrease from April, but saw a 3.4% increase compared to the previous year. This suggests that while the immediate outlook for new construction remains subdued, there may be some underlying resilience in the single-family housing segment. Now, the National Association of Home Builders, they reported a 6-month low in home building confidence in June of 2024. That's a survey that's sent out to home builders. The consistently high mortgage rates are cited as the major factor discouraging potential buyers from entering the market. Additionally, the rising cost of construction materials, they of course have to pay those to build a house, and the rising cost of labor, they have to pay somebody to do the work, further exacerbates the challenges faced by home builders. The combination of these factors suggests that the housing market is likely to remain subdued in the near term, with a potential for continued decline in both housing starts and building permits. This is why you're seeing a lot of home builders actually buy down mortgage rates to try to make affordability a little better. And finally, point number 4, any realtors out there selling existing homes, not the ones being built, but the existing homes. Well, let's see how you did last month. The U.S. existing home market experienced a decline in sales for the 3rd consecutive month in May of 2024. 3 straight months of lowering home sales, attributed to record high home prices and increased mortgage rates. This is creating challenges for potential home buyers to actually buy these existing homes. Existing home sales encompassing single-family homes, townhomes, condominiums, and co-ops, they decreased by 0.7 from April to a seasonally adjusted rate of 4.11 million units in May of 2024. This figure represents a 2.8% decrease compared to May of 2023, and the median existing home price reached an all-time high of $419,300 in May of 2024, a 5% increase from the previous month. Despite the slowdown in sales, demand remains strong, as evidenced by the rapid pace at which homes are going under contract once they come on the market. 2/3 of homes sold in May of 2024 were under contract in less than 30 days, less than a month, highlighting continued competition in the market. This is further corroborated by the fact that well-priced homes in good condition are selling quickly, while others remain on the market. Prices aren't right, not in great quality, for longer periods of time. Although sales declined, the inventory of unsold existing homes, that actually increased, funny enough, indicating a potential shift in the market dynamics. The inventory of existing homes for sale grew by 6.7% from April to 1.28 million units at the end of May of 2024, representing a 3.7-month supply at the current sales pace. This represents an 18.5% increase in inventory compared to May of 2023, just a year ago. The rise in inventory could potentially moderate home price growth in the coming months, offering some relief to prospective buyers. Good news if you're trying to buy a home. Hopefully these prices stop going up so much. Despite the increase in inventory, affordability remains the most significant concern, particularly for first-time home buyers. So look for some government help there in the next few months. The median price for existing homes has been consistently rising, reaching record highs in recent months. The mortgage payment for a typical home in 2024 is now more than double what it was 5 years ago today, primarily due to higher interest rates and a more than 50% increase in home prices over that 5-year period of time. This affordability challenge is further emphasized by the fact that sales of existing homes priced below $250,000 decreased compared to the same time a year ago, while sales in the higher price brackets, particularly those above $750,000, those experienced significant growth. So buying a house right now is not an easy task, but don't look for home prices to come down. Just look for rates to come down to make affordability a little better. And you're starting to hear, especially in presidential election season, guaranteed this is going to be something that is hotly debated. It's what does President Trump and what does President Biden want to do about making that first-time homebuyer have the ability to purchase a house for the very first time. Right now, it seems out of reach for many of those first-time homebuyers, but perhaps with some sort of government assistance, they can make that within reach a little bit more. Who remembers cash for clunkers done in the 2008-2009 time period to try to help the auto industry by incentivizing people to buy a new car, trade in their old car for a new car? That sort of option, some sort of financial incentive for first-time homebuyers, is probably going to be something that we're going to see them talk a lot about in these first few debates. The first debate actually coming up even before the conventions have finalized their candidates. Pretty interesting. So thanks so much for watching this week's video. If this week's video was helpful to you, would you do us a favor? You can do us a favor by hitting the like button. That pushes our content out to more people on YouTube and Rumble, as well as hitting the subscribe button, which allows our content to come to you as we release it. Additionally, if you'd like to meet with any of our financial coaches or advisors, our coaches help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, and live debt-free, or advisors who help you in baby steps 4, 5, and 6, so you can eventually get to 7. They'll help you build out that retirement plan, that college savings, as well as work through a plan to pay off your house early. You can go to the comments, click that link, and schedule with any of them. Thanks so much for watching this week's video. We'll look forward to seeing you next week.